If AI does actually start replacing real white collar jobs, to be proven out, but we'll see. And I think probably base case for me would be it will. Um, what happens to all the people that are unemployed? And do you think we see some kind of UBI? And if we do you see that as actual stimulus because it's real money going to real people in the economy rather than just creation of bank reserves?
Again, is if you think about it, ceteris paribus, taking the last part first, it looks like stimulus, but it's actually not because you have to account for the conditions that led to it in the first place. So we're redistributing money through UBI, assuming that's what happens. But it's intended to offset a hole that was created from the loss of jobs. So would it actually be stimulus? Well, in a ceteris paribus world where you're starting from scratch, yeah, it looks like stimulus, but it's actually, would UBI be an effective replacement and alternative for lost incomes, lost earned incomes through productive jobs? And looking at it that way, which is the proper way to look at it, it's not stimulus. It's actually it
It just nets
you
out
can
at zero.
argue it's better than zero, right? It's better than the alternative, potentially better than the alternative. I don't think the long run consequences would be better than the alternative, but in the short run, you could say it's better than having people have no jobs and no incomes. But it's certainly not stimulus because it's not offsetting what real earned income does for an economy, which is most consumers are more likely to spend spend more freely. Businesses too, when incomes are generated through natural, organic, and economic processes, then when they're redistributed through some predetermined, bureaucratically, arbitrarily determined number, which was what UBI would be by the federal government or any government for that matter. So UBI would not be an effective offset to lost jobs. So the question is whether or not we have lost jobs. I'm probably a little bit more optimistic than you about that. I don't think AI eliminates jobs. I mean, yes, it will definitely eliminate some jobs, but I don't think that's what we're not looking at a catastrophic loss of employment. I look at it as AI being a potential human robot partnership where it makes human workers so much more productive. In that case, it doesn't eliminate workers, it eliminates hours worked. So I can see us going, for example, from a 5-day work week to a 4-day work week, with some people actually having a 3-day work week because AI will make human workers so much more productive that just like when we went to a 5-day work week in the 1920s, businesses will first start out as using that as a recruiting tool. Look, come work for me. I'll pay you really well. Plus, you only need to work 4 days a week. And eventually that filters through the rest of the economy as that level of productivity really does take place in the real economy, which I think it will. Although I think it'll take a lot longer than people are anticipating right now, might be 10 years from now rather than next year or the year after. But I think long run, yes, there will be some jobs that are eliminated because that's the natural economic process. But by and large, we're not looking at mass dystopian levels of unemployment. We're looking at a positive future where we all have to work. We don't have to work as much. We can all work a hell of a lot less and still produce the same amount of output and probably produce a lot better output because AI, if it works the way it's intended to and way what people think, I mean, it has the possibility to, we'll all be better at what we do.
Well, that's a way more optimistic outlook. I like that. And that's what deflationary technology should always have been. Like it should be us at an office less and being more creative more.
Yeah, you do more, you get more out of less, right? That's what free market economics and capitalism is supposed to do. You have a set of finite parameters, and you learn how to use your techniques and processes better so that you get more out of what you're doing for less putting less in.
So just to go back to the potential that we're entering or in a financial crisis, how do people position themselves? Like, what should you be looking at as a way of sort of surviving this?
Well, I mean, the easy answer is just safety and liquidity. So, I mean, duration in treasury markets, because, well, not necessarily long duration, but some level of duration. If we do get to a situation where rates are going to go down by a lot because the marketplace sees that, even before you get to confirmation of the crisis coming, but the market sees the probabilities rise to a certain point, what you're going to see is short-term interest rates, medium-term interest rates are going to go down a hell of a lot more than long-term interest rates. So the yield curve will steepen out substantially, but do so from the front end. So like the 2-year, for example, the 2-year right now is a little bit under 3.4%, setting a new multi-year low, which is another signal leaning in the direction of that type of steepening. If that's correct, the 10-year is sitting at 4%. If we assume the 10-year doesn't go, it's actually a little bit below 4%. But if it doesn't go any lower, the yield curve wants to be relative about 200 basis points steep, upward sloping. It had been inverted for a long time, as we discussed before. It is uninverting. It hasn't gone through the entire uninversion process. When it does get through the process, which it will, the yield curve should be about 200, 300 basis points steep between the front end and the long end. So just doing some quick back of the envelope calculations, assuming the 10-year doesn't move any more than where it is right now, the front end of the yield curve would have to be down around 2% in order for it to completely uninvert and be 200 basis points steep. So there's a lot of opportunity in that part of the yield curve, right at the 2-year spot on the curve, and then even Treasury bills, though, I mean, there's no really price speculation in bills. But if you're buying a 2-year Treasury right now, not only are you getting around 3.5% of a coupon, you have lots of price appreciation built into it. So a curve steepening, bull steepening type of trade would work really well here, assuming that it continues to go in this direction, though, like I said, we've been looking at this for years, and as we continue to go through year after year after year, we see more evidence of that taking place, not less evidence. So it's a relatively easy thing to do. But that's, I mean, Treasury market's easy. You want to take a little bit more risk, you could buy gold or something like that. I would buy a ton of Bitcoin. If Bitcoin gets down around, 50,000 or less, if the market overshoots on the downside, I'm going to pack up the truck for Bitcoin or something like silver, because those are the things that you're going to want to own in a period of instability, gross instability in a whole lot of different ways, including the economy and the marketplace. So yes, there's a lot of caveats and a lot of ifs and a lot of probabilities, but as those probabilities start to pile up and it looks like more concretely, that's where we're going, that's where you really want to be. All the traditional tools that safe haven to get you through unstable periods.
I mean, that's cool to hear you talk about Bitcoin in that way, because you've always been sort of a little skeptical of Bitcoin. Is it just the fact that it's pulled down so much from its highs that you're interested at this point, or have your sort of opinions changed on it slightly?
No, my problem with Bitcoin, it's not really a problem. It's understanding what it is and where it's going. Not price, but actual function. Bitcoin is not replacing the US dollar. Bitcoin is competing with gold as a safe haven portfolio asset. That's why it behaves a lot like the NASDAQ. It's competing with the stock market or gold. So people look to Bitcoin as potentially since it has a relatively small market cap, there's potentially, as more and more people get interested for any reason, doesn't matter what it is, there's a lot of upside potential from Bitcoin. Even though it doesn't replace the dollar, it doesn't become the next big currency, it can still become a highly appreciative asset, a speculative asset, or a store of value asset, certainly. So if Bitcoin goes down with that level of price appreciation, the asymmetry works in your favor, because there are so many long run positives to owning Bitcoin. If we see Bitcoin at 20,000, you got to be buying every last thing every last bit you can get. So my issue is, I don't see Bitcoin becoming a currency system, but I see it becoming what it already is, which is a preeminent digital form of portfolio asset. And there's nothing wrong with that. We can use a digital form of portfolio asset, especially one that has limited supply and limited availability. There's nothing wrong with that whatsoever. It's just it's not a dollar. It's not a competition for the dollar. That's really where I have the argument.
So we've had that conversation on the podcast before, and your issue is around like the inelasticity of Bitcoin. I'll just link that in the show rather than getting into that again, because we've covered that in pretty good depth, I think. So one of the things that I like in terms of the framing of how Bitcoin performs in the short term, how the price moves, is Luke Gromen's theory that it's like the last functioning smoke alarm for liquidity. Obviously, Bitcoin rolled over at the end of last year. Do you think that is global liquidity drying up, or like the smoke alarm that it's about to dry up?
Yeah, I think it's both a liquidity signal as well as a risk-taking signal. It's sort of the marginal. It's at the margins of people's perceptions of whether or not they want to take risk or whether or not want to remove risk. That's part of that's part of the institutionalization of Bitcoin through Wall Street and funds and everything else. That's what it kind of becomes, is the sort of the easiest thing to sell in a downturn, in this downturn anyway, assuming that's what we have. Portfolio manager, hey, Bitcoin had a tremendous year last year. It's really easy to get out of it. Plus, as it becomes, price goes down, portfolio managers don't want to own it because their clients will fire them for owning it. So it becomes the marginal risk setter. It tells you something about the perception across the financial markets to take additional risk or to take additional risk off the table. So for me, yeah, that's one of the things that that really stuck out, is that Bitcoin had, it really is, it hit the high in October, but it started to roll over in July, when we see a lot of stuff roll over in July, private credit in particular, you look at the BDC prices in the stock market, you look at leverage loan prices, for example, there is a pretty solid correlation, at least a rough correlation, between Bitcoin as a risk gauge and what we've seen for example, the reversal of the private credit bubble. So that's how I would look at Bitcoin. And if, like I said, if Bitcoin goes lower for whatever reason, just because it happens to be the easiest thing to sell, that just presents a tremendous buying opportunity.
Yeah, I mean, down here in the 60s, I think it's already good value. It may go to the 50s, who knows? But
you know how this
yeah,
goes, Dan? I mean, markets always overshoot. In Bitcoin's history, right? I mean, Bitcoin goes way up and then it goes down by what, 80, 90%, and then it goes way back up again. So, I mean, I don't think people would be shocked if it gets down to around 80% down from its high, which would be what, 30,000, something like that. I mean, 30,000, you got to be thinking about buying a ton of it.
yeah. I mean, if we get there, I will be selling everything I've got to buy more. But
You and me both. I'll provide some leverage. We see if we can find some leverage someplace.
just to close out, I know you're kind of tight on time, and this is quite a big question to close out with. Going into the midterms at the end of this year, Trump is going to want the economy running as hot as possible. Do you think he's got a chance of getting there? Do you think this could be a really strong year in the markets?
No, see, it's always what people want versus what they can actually deliver. Same thing with the problem with the Fed. One of the biggest things I try to get people to get out of is the mindset that governments can achieve whatever they set their mind to, because we see examples of this not happening everywhere. The recovery after 2008 never happened, didn't happen. China's a perfect example. Chinese have been stimulating their economy for years, and it only gets worse and worse and worse. Governments don't have unlimited capacity to achieve the goals that they set out. In fact, they have very limited capacity, far more limited than you think, which is one reason why, again, go back to the marketplace. The marketplace has not budged. There is nothing in the marketplace right now that suggests, and believe me, market participants know, the Republicans and the Trump administration want the economy on the right track long before we get to November. This talk about a boom in 2026 is not priced anywhere in the market. And if it was, we would have the reverse calculation of what I just went through. If there was a plausible path to the Trump administration stimulating the economy this year, what we would see is the yield curve steepening out in the other direction. So short-term rates would be stuck at 350. The Fed wouldn't need to cut rates anymore, right? Because it would be responding to a strong economy, which means that the long end of the yield curve would have to be at least 200 basis points above the short end, which gets you the 10-year around 5.5%, if not 6% or higher. It's not moving in that direction. And if this was a realistic possibility in the near term, you better believe the marketplace would be already moving in that direction. So what the market is saying is, yes, we realize that Trump would love the economy to be red hot running into November. We just don't see any way for that to take place. The conditions, labor market is too sour. I want to point this out. I don't know even how to put this in the right words. We had zero job growth last year. I don't know why people don't know that more. We had no jobs in the entire U.S. economy, an economy with 160 million people working. We had zero job growth in 2025, and somehow that's not going to have a negative impact on 2026. So the point is, the market is saying, look, we've been in this rut for years. It only gets worse. It only seems to move in one direction. It doesn't matter what the government wants to do. It's the conditions that we have, and then unfortunately they progress too far to the wrong direction that we're kind of stuck in this direction, kind of stuck in moving this way. Plus, you throw a private credit mess on top, and let's not forget, maybe the stock market pops because the AI bubble is no longer supporting that narrative. I mean, there's a number of financial risks that are out there on top of the macroeconomic weakness. It's a very small possibility that the Trump administration is able to deliver what it wants to deliver. I think that's what the markets are all saying.
It's going to be an interesting 2026. Jeff, I always love speaking to you. Every time I feel like I'm getting a grasp of what's going on in the economy, I speak to you and realize I need to start again. But thank you for coming on the show. Really appreciate it.
Always, Dan. I'll always love talking with you and catching up and revisiting.
Yeah. So tell everyone where they can go to find out more about your work in case they want to check it out.
Yeah, just look for Eurodollar University. I've got a YouTube channel. I've got subscription services where if you really want to get deep into the weeds about what all these signals are, what they mean, what they're doing, which, I mean, recent events suggest that you need to do that more now than ever to really stay abreast of what's taking place and what's really happening and what it means, what it potentially leads to down the road. Like I said, the subscription services you can find at Eurodollar University. The website is eurodollar.university, or just search for Eurodollar University. The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.